Guys, the Federal Reserve just made a major move with our money system, and it's not getting the attention that I think it should get. After 3 straight years of pulling money out of the economy to fight higher prices, the Fed is now officially stopping that process. They're done shrinking the money supply. And in just 10 days, on December 9th and December 10th of this year, the Fed is going to meet again to decide whether they're going to cut interest rates or not. And when you put all of this together, guys, the Fed might be getting closer to turning the money printer back on. Now, this kind of change affects everything, right? Our mortgage rates, our credit card interest, our jobs, our investments, and even how far our paycheck goes every couple of weeks when we get paid, right? So let me break this down to you in plain language, okay? How the Fed prints money basically out of thin air. Here's how the money printing system really works, okay? When the Fed wants to put more money into the economy, or more money into circulation, the Fed does something called quantitative easing, or QE for short. Now, what is quantitative easing? In simple terms, QE is just more money in the system, more liquidity in the economy. Okay, so here's the process. Here's how it all happens. Okay, step one is this. The Fed decides, hey, we're going to add money back into the economy to stimulate the economy, right? Get things moving, get people buying, right? So the Fed prints money. Now, the second thing that happens is the Fed then takes that money and buys U.S. government bonds. The Fed buys these bonds from big banks or, huge financial companies, right? Because they're the ones who hold billions of dollars of U.S. bonds. Now, the third thing that happens is the Fed pays for those bonds with this new money that was just printed, right? And this is the part that people really don't understand. The Fed doesn't use money from a bank account, right? The Fed, they don't sell anything. The Fed doesn't raise taxes, right? The Fed just literally creates brand new digital dollars out of thin air. And that's, again, the dollars they use to buy these bonds, right? Money created from nothing. The fourth step is that the new money goes into the banks when the Fed buys the bonds with the new money. The banks, in turn, give the Fed bonds. The Fed becomes a bond holder, and they just bought the bond with new money, right? The banks get that new digital cash, okay? Now, the Fed gives the banks this fresh money that didn't exist before. Now, all of a sudden, banks have way more cash on their books. And what do you think the banks now do with all this new cash? That's step 5. Banks push that money into the economy. How? Well, those banks, now that they have all this new money, they use the new cash to make loans, to give credit, to fund businesses, right? To help people buy homes, buy cars, right? So more bank money equals more money everywhere. That's more money in circulation and more liquidity. That's how the Fed prints money and injects that money into the economy just by buying bonds with the new money. Now, let's talk about the pandemic, because this is going to sort of illustrate this whole process, right? In 2020 and 2021, the Fed didn't just print new money. They really went wild with printing new money, right? The Fed bought trillions of dollars in bonds from banks using money that they created out of thin air. And they put those bonds on their asset side of their balance sheet. And at the exact same time they were doing that during the pandemic, the government was giving out stimulus checks. Also, the Fed made interest rates super low. So borrowing money became easier during the pandemic. People were spending more than ever before. So you had more money from the Fed out there in circulation because they injected money into the banks by buying their bonds. There was more money from stimulus checks that people were using to buy stuff, right? More money out in circulation. And then you had cheap loans, more spending, and you had the same amount of goods. Now, listen, when too much money chases the same amount of stuff, what happens? Prices jump up fast and inflation skyrockets. And that's exactly what happened in 2022. Right? In the summer of 2022, we looked at inflation, and CPI headline inflation was over 9%. Inflation went way up, right? High inflation didn't just show up out of nowhere. It was caused by all the new money that was injected into the economy. That whole process is what we call quantitative easing to stimulate the economy and get people spending and put money in circulation. Now, here's why the Fed had to reverse that course in 2022. Like I said, by 2022, the summer, inflation was incredibly high. So that's when the Fed flipped this thing around. And they did two major things, okay? The first thing the Fed did immediately when inflation went way up is the Fed raised interest rates fast and a lot, right? Borrowing then became more expensive across the board, right? So what does that mean? When borrowing becomes more expensive, it slows down the economy. And people stop spending and borrowing so much. That's the opposite of what they were doing at the beginning of the pandemic. Now, the second thing the Fed did towards the end of 2022 is the Fed started quantitative tightening, which is the opposite of quantitative easing. In other words, the Fed started letting those old bonds roll off their balance sheet and not replacing them. See, every balance sheet has assets and liabilities. Well, on the Fed's asset side of their balance sheet, that's where they, again, tossed all those bonds. Now, during quantitative tightening, the Fed let those bonds go and just disappear back into thin air. This means this: the Fed's balance sheet slowly begins to shrink and money now sort of comes back out of the system. And the old bonds, those old bonds that the Fed bought back during the pandemic, they never get paid. They simply just disappear. They quietly expire. QT was the Fed's way of sort of unprinting money, so to speak, right? And the Fed really has been doing quantitative tightening for the last 3 years straight. Now, let's talk about right now. The Fed announced that they're going to stop shrinking the balance sheet on December 1st. That means no more pulling money out of the system. No more quantitative tightening. That's a huge signal, or it should be a huge signal to all of us, because it means that the Fed is now worried that the system might run low on cash. They don't want bank reserves to be too tight. And it's a big indication for me that the economy is really slowing down, right? If you're a consumer, you're an investor, you should know stopping QT puts us one step closer back to quantitative easing again. And that's where the real money printing just begins all over again. Is the Fed about to start printing money again? Look, here's the deal. I don't know. Not today, right? Probably not tomorrow. But listen, they're closer than they have been in several years. Stopping QT is just the beginning, right? Keeping the balance sheet steady is step 2. Buying bonds again with new money again to stimulate the economy all over again, that's step 3. We're not there yet. I'm not saying we are. Once the Fed starts buying bonds again, that's going to be our money printing 2.0. But again, we're not there yet. Okay. Now, when that happens, stocks are going to probably rise even further. When that happens and QE begins again, real estate is probably going to get a boost, right? Borrowing is going to get easier and cheaper. But you have to remember this: that also causes your dollar to become weaker. More money in the system can be great for assets, right? But more money in the system is bad for your everyday wallet because cheaper money causes the value of the dollar to drop. So let's talk about December 9th, December 10th coming up, the Fed meeting. This is a big one. Most experts right now believe that the Fed is going to cut interest rates by another 25 basis points, which is a quarter of a percentage point. Why? Well, layoffs are rising. Unemployment is up to 4.4% that we saw at the last reading. Jobs are weakening. Prices are still high. Some economic data was delayed because of the government shutdown, and the Fed wants to avoid a recession. And we also know that the overall economy is slowing down when we look at all the numbers. And so a rate cut coming up can help borrowing, but it also keeps higher inflation alive for longer because cheaper money means more spending, and more spending leads to higher demand and leads to prices rising faster, which is higher inflation. So this meeting coming up is important because it shows us, or it's going to show us, how close the Fed really is to turning that money flow back on. Now, what this means for regular people. Let's talk about just regular, everyday, average Americans, okay? Here's what it means. 1, prices won't fall fast. Okay. Food, rent, gas, all those things are still going to be higher than normal or higher than we want, right? The second thing it means is credit card rates are also going to remain high. And that means you want to avoid that bad debt. It also means that ultimately down the road, coming up, mortgage rates will come down, but it won't happen suddenly. Okay. They're going to move down slowly as the Fed continues to perhaps lower the Fed funds rate. Also, stocks may benefit from all of this. Because the stock market prefers when the Fed is easy, right? The Fed is participating or doing quantitative easing. That's always a good thing for businesses, right? Because that stimulates spending, and businesses like spending. Also, your dollar loses buying power. As I said before, more money printed equals a weaker dollar. Keep that in mind. But also, asset valuation might rise if the Fed begins printing money again as well. So stocks, real estate, all those things tend to benefit when money is cheaper to borrow. But none of that helps if your personal finances and your own four walls is a mess, right? So you want to make sure that you get all of your ducks in a row as we approach a possible QE situation again. Here's how to prepare. First, make sure you build a strong cash position, real savings, okay? 6 months perhaps or more of living expenses. Number two, stay away from the bad debt, right? High interest debt is a trap, but bad debt is debt on anything not going up in value. Steer clear of it right now, for sure. Third thing you can do right now is own cash flow assets, buy cash flow assets. And listen, it's always a good idea to own businesses. It's always a good idea to own rental property, right? It's always a good idea to own dividend paying stocks and ETFs, right? Things that pay you is always a good idea. So own some cash flow assets. The fourth thing you can do is make sure you're playing the long game in the market, not playing the short game. Buy, get out, buy, leave, buy, sell, buy. No, don't try to time the Fed and what they're going to do with interest rates, and definitely don't try to time the market. So listen, that is what we should be doing. This is why I say that they're about to reset your money, and we need to be paying close attention. So I hope this quick video helped you out, helped you learn something about why I believe that they're about to reset our money. So we need to be following the Fed and seeing what they're going to do at the meeting coming up in terms of lowering the Fed funds rate. So hopefully you got value from this video. Now look, guys, if you want tools, resources, and guidance to build long-term wealth with clarity and intention, head on over to smartmoneybro.com. Everything you need is over there. And listen, if you got value from this quick video, this update, do me a favor and smash that like button below. Share this video, and I'd like to invite you to leave a comment below. I read them, so I'd love to hear from you. Listen, the best person to take care of the old you is the young you. Until the next video, peace.